welcome to the deep dive. So, you've brought us the unaudited financial results for Xpeng.
Yep, for the third quarter ending September 30, 2025.
And this feels like it's not just, a simple numbers readout. We're really trying to figure out what's hiding behind this incredible growth story from Q3.
That's exactly it. That's our mission. We've got to do two things and do them quickly.
Okay.
First, we need to see if all this volume is actually leading to efficient operations, to real margin growth.
And the second thing.
We have to trace where the money is going because Xpeng is making this really radical pivot. They want to be, in their CEO's words, an embodied AI company.
And the headlines, they definitely look good. The theme seems to be record results just everywhere.
It is across the board. We're talking record deliveries, record revenue, and a really big one, record gross margin. Plus, just a ton of cash on hand.
It sounds like a true inflection point.
It absolutely is.
Yeah.
So let's start with the foundation, the thing that makes everything else possible, scale. Because in the auto industry, you just have to have massive volume to make the numbers work. And Q3, for them, was a volume steamroller.
Okay, so let's get into it. How aggressive was the scaling up, really?
So they reported total deliveries of 116,007 vehicles, just for the quarter.
116,000.
Yeah. To really put that in context, you have to look back a year. In Q3 2024, they did about 46,500.
So that's a 150% increase?
Almost. A 149.3% year-over-year increase. It's just relentless expansion.
And that's in a market that is, let's be honest, incredibly competitive.
Yeah.
That kind of growth says they're taking serious market share.
They are. And this wasn't just a one-off spike either. We even have the snapshot from October 2025.
Yeah.
They kept up the pace. Over 42,000 deliveries in that 1 month alone. It shows the whole machine is really humming along now.
Right, and you can't get that kind of volume without the actual physical infrastructure to back it up.
Exactly. The report notes they've expanded to 690 physical stores.
690.
Across 242 cities. They're not just some online brand. They're building a real physical presence.
And more importantly, they're solving that classic EV problem, the biggest one, charging anxiety.
Oh, absolutely.
Yeah.
They're now operating over 2,600 self-operated charging stations.
But the key detail, I think, is the type of station.
You're right. It's that over 1,600 of those are their ultra-fast S4 and S5 charging stations.
Which is the difference between a charging network and a premium charging network.
That's the perfect way to put it.
Yeah.
S4 and S5, that's their rapid charge tech. It's a huge differentiator, especially as they scale up. It locks in that customer loyalty.
And it sounds like they expect this to continue. I saw their Q4 projections.
Yep. They're guiding for even higher volumes. They expect somewhere between 125 and 132,000 deliveries.
So management is basically saying Q3 was the new floor, not the ceiling.
That's the volume story. We've established the scale. But, huge scale often comes with huge losses, right? Especially in EVs.
For sure.
So let's see if that growth is actually sustainable. This is where we get to the real headline number of the quarter.
You have to be talking about the gross margin finally breaking that 20% barrier.
Exactly. Gross margin hit 20.1%. For you, the listener, that 20% mark is it's a huge psychological milestone for a scaling car company.
It basically says they're past the really painful part of high production costs and are starting to hit real economies of scale.
That's it. And it's a massive jump in efficiency. What was it last year?
I'm seeing it here. It was 15.3% in Q3 2024. So that's almost a 5-point jump in just 12 months. That is some serious optimization.
It speaks to both cost control and, pricing power. And that margin growth led to some serious top-line numbers. Total revenues hit 20.38 billion RMB.
Which is about 2.86 billion US dollars.
A doubling of revenue year over year.
But the true health check, I always think, for a company like this, is the net loss figure. Are they getting closer to breaking even?
And the numbers suggest they are, and fast. The GAAP net loss, which is the most conservative measure, was cut way down to 0.38 billion RMB, about 50 million US.
Okay, and compare that to a year ago.
A year ago, they lost about 250 million US dollars. The improvement is just staggering.
Wow. But analysts always seem to focus on the non-GAAP net loss. Can you just quickly remind us why that number is so important for these tech-heavy companies?
Yeah, good question. Non-GAAP, or adjusted loss, it strips out non-cash expenses.
Yeah.
The big one is usually stock-based compensation.
Okay.
So it gives you a much cleaner picture of how much cash they're actually burning just to run the day-to-day business.
And that number was?
It was reduced by over 90% year over year, 90.1%. It's down to just 0.15 billion RMB. They are knocking on the door of operational profitability.
So the cost controls are really working. And they're doing all this while sitting on a pretty big pile of cash.
A massive pile. Their balance sheet is strong. They're holding almost 7 billion US dollars in cash and short-term investments.
That's the war chest they need to keep funding that aggressive R&D.
Right. It gives them the runway. Okay, so the foundation is solid, but now let's dig into how they got that margin, because this is where you can see the strategic pivot in the numbers.
You mean breaking down the difference between the margin on the cars themselves versus the margin on their services?
Precisely. Let's start with the core business, the vehicle margin. So the profit just from selling cars, that was 13.1%.
Which is a nice improvement from 8.6% last year, so they're getting way better at building cars efficiently.
They are.
But wait, I'm looking closer here. That 13.1% is actually a little bit down from last quarter, from Q2. It was 14.3% then. What happened there?
That's the crucial detail. The company calls it a product generation transition.
Which is corporate speak for.
It's the cost of launching new models. They're absorbing the high initial tooling and manufacturing costs for their newest cars.
So it's a short-term hit to the margin, but it's in exchange for long-term growth from these new, more desirable models.
Exactly. The high sales volume was driven by these new launches, even if it pinched the vehicle margin just a little bit, quarter over quarter.
Got it. The trend is still positive.
Right. But here's the real kicker. Here's where the story gets really interesting and how they got to that overall 20.1% gross margin. It's the services and others segment.
The non-car income. And that revenue grew almost 80% to 2.33 billion RMB. That's impressive on its own.
It is, but look at the margin on that revenue.
Ooh, 74.6%.
74.6. I mean, think about that number. That is an astronomical profit margin for anything related to the auto industry.
That's software territory, not, selling floor mats and oil changes. What on earth is driving that kind of profitability?
Well, the report points to two things. The first is normal after-sales services. But the big driver, and I'm quoting here, was technical research and development services rendered to a car manufacturer.
Hold on. So they are licensing their core tech. They're selling their R&D to another car company, maybe a competitor or a partner.
That's what it looks like. This completely changes the business model. It positions them as a technology vendor, not just a car maker.
That high-margin R&D service revenue, that's the key that unlocks their overall profitability. It proves their R&D spending isn't just a cost center. It's creating IP that other companies will pay a premium for.
It's Xpeng telling the market, we are more than just a car company.
Which brings us right to the last piece of the puzzle, connecting that technical success to their strategic spending. We need to look at how much they're investing to create that R&D in the first place.
And they're spending a lot to stay ahead. R&D expenses were up almost 50% year over year, hit 2.43 billion RMB.
And that's specifically for new vehicles and new technologies.
This is the capital that's feeding that 74% margin pipeline we were just talking about.
It links directly back to what the CEO, Mr. He, said, that Xpeng is in the early stages of rapid expansion and will become a global embodied AI company.
Embodied AI. That's the phrase. It means AI that lives in the physical world, not just software on a screen, but intelligence inside cars and robots.
And the report says their future projects, like robotaxi and humanoid robots, are moving fast toward mass production. This isn't just a dream.
No, they're putting real money behind commercializing these autonomous physical systems.
And they even showed off some of it recently, right, at their AI Day event in November.
They did. They demonstrated their new AI model, VLA 2.0, a specialized robotaxi platform, and even their next-gen humanoid robot. They are betting the tech that powers their cars can be applied to all kinds of robotics.
Creating multiple high-margin revenue streams.
That's the plan. And just to close the loop on costs, their SG&A expenses, so selling and admin, also went up.
But that's a good sign in this case, right? It's because sales volumes are up, so commissions are up, and they're spending more on marketing to expand.
Exactly. The cost increases are proportional to the explosive growth.
Okay, so if you had to boil this entire complex report down, what's the single biggest takeaway for you?
I think the Q3 results signal a real transformation. On one hand, they are crushing it in their core business. Record deliveries, better vehicle margins, good cost control. But their future, their really high functions, are now being unlocked by their success as a technology provider. They prove they can sell their R&D for a huge profit right now.
That monetization is the critical piece. A 74.6% margin on technical R&D services means the tech they built for themselves is so good, others are willing to buy it or license it.
Which leaves us with the final provocative thought for you to chew on.
Go on.
If Xpeng can successfully sell its proprietary AI stack, its driving software, its robotics platforms to other major global car makers, what does that say about their long-term strategy?
That they don't just want to be a car company.
They might be aiming to be the technology platform, the Android, or the Windows of physical AI and mobility. A company whose revenue is only partly tied to the cars they actually sell themselves. That potential shift from manufacturer to a dominant tech licensor, well, that changes the entire game.